The next budget could reshape how much tax you pay. And with the UK economy completely flatlining, all eyes are now on Rachel Reeves to see what she'll do next. And as someone who's worked in finance for over 15 years, I've been following the plans, leaks and proposals very closely. So in this video, I'll break down the biggest tax changes that are currently on the table and what they could mean for your money. From pensions and income tax to council and inheritance tax, we're going to be going through all of it. So let's start with the big one, income tax. It's the area that everyone is watching, and depending on what Rachel Reeves does here could mean big changes for millions of families. And if we defer back to this trusted diagram from the good folks at the Tax Policy Associates, you can see that income tax and national insurance are the two big taxes that do most of the heavy lifting. And there are a variety of proposals on the table here. The first is to raise income tax by 2%, but then cut employees' national insurance by the same 2%. More on why in a second. Such a move would yield £6 billion, the foundation said, because income tax is also paid by pensioners, landlords and self-employed, while salaried workers would see no increase in their tax bill. And it tries to, I suppose, change one of the weird quirks that we have in the UK tax system, where we essentially have two taxes on income, but they're charged at different rates, not on the same kind of income, have different tax treatments, different pension treatments. You get what I mean. Then there is a second income tax change. And as always, there is the prospect of freezing income tax thresholds again. But take a look at this here. Labour's manifesto promise not to raise income tax on working household has long been undermined by Reeves's decision to maintain a freeze on income tax thresholds, first introduced by Rishi Sunak in 2021. The Chancellor is widely expected to extend the freeze by an additional year to 2029 to 2030, generating in the region of an additional £10 billion. And this is a sneaky one. There's no two ways about it. And the number of people in the UK paying the top rate of income tax is expected to rise by 500,000 to 7 million people this tax year. And for a tax bracket that is really supposed to hit only the most well-off, 7 million workers seems like rather a lot. Next up, we have another big one, pensions. So there are two possible changes to pensions that are floating around the rumour mill at the moment. The first is a change to your tax-free lump sum. Now, just take a look at this. Last year, it was expected that the government might further restrict the 25% tax-free cash that can be taken from pensions, currently capped at £268,275, or reduce the higher rate tax relief on pension contributions. And it looks as though both of these may well be in the crosshairs again this year. But I want to revisit this article from Fidelity right at the end, because I think no matter what happens with taxes, what they fiddle, what they fettle with, I think the article makes probably the most important point of the whole video. Now, there are a whole lot of options about what you can do with your tax-free lump sum. Some people use it to pay off their mortgage. Some people transfer it to an ISA where you have easier access, maybe until you qualify for a state pension and so on and so on. Personally, not my favourite option, but that's another video for another day. But the problem I have with a lot of these strategies is that you are always hoping that the 25% tax-free lump sum will be there. And if that is your plan, or even just your primary plan to pay off your mortgage, it just feels kind of risky to me. A change in these rules and you could have a mortgage much longer into your life than you expect and end up paying much more in mortgage interest than you expect. But I'm afraid to say the bad news does not end there. There is also a second proposed change. So at the moment, pension contributions get tax relief at your marginal rate of income tax. That's 20% for basic rate taxpayers, but 40% or 45% for higher earners. So what this means is that the more money you earn, the more tax relief from HMRC you get on your pension. And it's a very sensible way the government can encourage people to save privately for their retirement. It's not without its flaws, but again, more on that another time. So to level the playing field and cut costs, there is speculation of replacing this with a flat rate of maybe 30 or even just 20% for everyone, no matter where you land on the income scale. This would reduce the perk for high earners, but boost it for lower earners. A change like this is expected to bring in £15 billion, council tax. So let's get this out of the way straight away. Council tax is a terrible tax. There, I've said it. I'm sitting here in this house paying over £4,000 per year in council tax, and I'm in one of the councils run by Reform, not a Labour council. But Buckingham Palace, where the literal king lives, pays £1,828 a year. Insane, totally nuts. If you wanted to create the world's worst tax in a lab, you still couldn't come up with something as downright daft and stupid and moronic as the current council tax setup. But it's not just an outdated tax, it's also an incredibly regressive tax, meaning that properties worth hundreds of millions of pounds pay almost nothing in council tax. We've discussed this in another video about how the average house in Blackpool, one of the most deprived areas in the UK, pays about 1.1% in the value of the property in council tax every year. The same value for the snazzier parts of London like Westminster, that amount is closer to 0.1%. So there is a lot that can be done with council tax, and that leads us to this. The government is thought to be considering plans to scrap the current system of council tax and stamp duty to introduce a progressive property tax on existing homeowners and new purchasers that would be applied at a higher rate for those who have the highest value homes. That is a tax cut for the people in Blackpool and a tax increase for the people in very, very expensive homes in London and so on. But there are other proposals in the works. There are also things like the introduction of a new council tax ban for higher value properties could be considered. Now, the idea here was to address the absolute absurdity of the example that I gave earlier. The maximum band at the moment is about £320,000. If you had additional bands at maybe £500,000, £1 million, £5 million, £10 million and so on. But to my mind, this doesn't necessarily solve the problem, it just makes it a bit less bad. Those additional council tax thresholds could help to charge more on those more expensive homes. Inheritance tax. So again, there are two possible changes on the line here. So at the moment, the amount you can pass on inheritance tax-free via gifts is essentially unlimited, provided that the person who makes the gift lives for 7 years after they make it. This follows something called the 7-year rule, which is a tapering percentage that declines with each year from the time the gift is given. Now, the idea here is to encourage people to pass on their assets to their children or grandchildren gradually over time, rather than in one big chunk right when they're about to die. And you sort of see this in the data. The evidence is here. The annual report of Savills suggests that 52% of first-time buyers received assistance from the bank of mum and dad last year, which could also include other donors from the family. But a lifetime cap is being proposed. This would basically cap the value of gifts over someone's lifetime and would be a very different proposal and a potential nightmare for tax planning purposes. Now, as always, we should point out that only about 4% of estates in the UK are currently liable for inheritance tax, but given, again, these thresholds have been frozen, this number is estimated to reach between 7 and 10% in the next few years. This is down to two things really, the inclusion of pension in the value of someone's overall estate and also increasing house prices. We have a video just here, link will also be at the end, on about how you can pay less inheritance tax. 2-child benefit cap to be scrapped. But on the good news, there is also speculation that the government is looking at the 2-child benefit cap and the possibility of lifting it. Now, the limit was introduced in 2017 under George Osborne, and as we can see here, child poverty for those households with more than 2 children has increased, and The Guardian has reported that Rachel Reeves will lift the 2-child benefit cap in the budget, saying, quote, government officials are reportedly considering options including a higher cap alongside a tapered system for larger families. The policy currently prevents families from claiming the Universal Credit Child element worth £292 a month for a third or subsequent child born after the 6th of April 2017. The Chancellor said that lifting the cap entirely would depend on finding the money to pay for it. The Institute for Fiscal Studies has estimated that removing the limit would cost £3.4 billion a year. And with child poverty in the UK reaching increasingly higher and higher levels, this would potentially be a game changer for some of those families. Stamp duty. So as we mentioned earlier, there are currently plans to potentially scrap stamp duty and introduce a progressive property tax on existing homeowners. And the proposal is looking something like this, proposing a system of annual property taxes applied on homes worth more than £500,000. Now, the Conservatives just had their party conference and went a step further. At Conservative Party conference this month, leader Kemi Badenoch announced that stamp duty would be abolished entirely if she were Prime Minister. You look at where the Tories are in the polls and it's easy to promise people absolutely anything you like, but never mind. On to the next one. Now, under one of the proposals that's been kind of floating around in the ether, property values over £500,000 would face a levy of between 0.3 and 0.6% per year on the value above that £5,000 threshold. And then again, potential additional bans above that. And, look, let's just say it out loud. Like council tax, stamp duty is a nightmare. It keeps people trapped in houses they don't want to be in, stops elderly people from downsizing, keeps people from taking jobs that they might be better suited for, but are just in a different part of the country. So reform here can be a good thing, but the key question will always be, what are they going to replace it with? Capital gains on primary residences. Now, this is a bit of a weird one. At the moment, any profit that you make from the sale of a second home are taxed at varying rates because it is basically a capital gain, but profits from selling your primary residence are untaxed. This is called the Principal Private Residence Relief. Not a very catchy name, but okay. But take a look. The Treasury has explored a new tax on the sale of homes over £500,000 and the removal of capital gains tax exemption on primary residences above £1.5 million. So looking at this one specifically, the budget could potentially remove that exemption for homes valued over 1.5 million. This would mean that any gain over that cap would be subject to capital gains tax, and this is estimated to raise about £1 billion a year. And one thing that I'm getting from this is it increasingly seems like property taxes could be due for a real shake-up, with council tax, stamp duty, and this capital gains tax change all in the crosshairs. So it'll be really interesting to see how all of these could combine to form some other kind of tax system, which hopefully might be a bit fairer. Next up, landlord taxes. So right at the start of the video, when we were talking about income tax, we talked about how national insurance and income tax are two weird taxes that are supposed to do the same thing, but don't really do the same thing at all. But take a look here. There is speculation that the government will force landlords to pay national insurance on rental income, a plan that could raise in the region of £2 billion a year. And there is some analysis out there already on this. Take a look. According to the Office for National Statistics, landlords earned £27 billion net of property income in tax year 2022 to 2023. An 8% national insurance levy on that would have generated £2.2 billion. So at the moment, landlords don't pay national insurance on rental income. This change would basically treat that rental income like most other kinds of income, taxing the banks. So Labour probably would hate to admit this, but this is an idea that I think actually came from Reform first in their manifesto. But this one can be a bit tricky, so take a look at this. Bosses have been spooked by proposals from the Institute for Public Policy Research, a left-leaning think tank, for the government to tax income generated by banks that earn interest on money parked to the Bank of England. The central bank pays the base rate reserves held at commercial lenders, currently at 4%, providing a lucrative source of money that's been called an unfair subsidy by the likes of Reform UK and the former Chancellor and Prime Minister Gordon Brown. The IPPR said this income should be hit by a windfall tax that could raise £8 billion. So, as insane as it sounds, taxpayers pay interest to banks for money that they have sitting in accounts at the Bank of England at a rate of 4%. And now we have a gambling tax. Now, to add to the long list of sin taxes, gambling has also been rumoured to be in the crosshairs. Reeves is expected to heed calls for a new gambling tax that could raise upwards of £3 billion a year. Gordon Brown is among those supporting plans to target the profits of online betting casinos, slot machines and high-stakes betting. The IPPR has said the funds can be used to reverse the decision to scrap the two-child benefit cap. Now, I promised I would, so I want to revisit this article that we discussed earlier from Fidelity. Here, I'm sure you'll recall they're talking about the much-discussed proposed pension changes from last year. The crucial thing to remember is that, for the moment, this is all pure speculation. Making snap decisions based on rumours can derail long-laid financial plans and prove very costly in the long run. Although pension providers reported afterwards that there had been a spike in people accessing pension funds in advance of the budget, this may have had negative consequences for future financial planning for those individuals. This highlights the dangers of making financial decisions on the back of speculation without seeking advice or guidance on your options. And I think this is really the most important thing. All of this is speculation, none of this is set in stone, and whilst, yes, on occasion you might find that you get on the right side of potential legislation changes, it's just not a guarantee, so it can be very, very risky to do. In my view, Rachel Reeves only has one more chance. This feels like a big budget, and it seems like the last budget was a bit of a wet fart, so the pressure really is on for them to deliver something meaningful, especially given the UK's completely flatlining performance. We have this video here about how to pay less income tax, this video here about how to pay less tax on your savings, and this video here about why £120,000 is the worst salary in the UK. If you've liked this video, please like and subscribe. Thanks for watching.